Welcome to the Ask About Wealth podcast, episode 4. Today I'm going to talk about inflation, and in particular how inflation impacts on your efforts to accumulate wealth. So what is inflation? Well, inflation is the reduction in buying power due to rising prices. Prices of our groceries, prices of our services, prices of our petrol. All of these things are rising in price, which means that the euro in your pocket is effectively falling in value. If you could have bought something for €1 last week and inflation is 3%, then you pay €1.03 for it this week. So to put that into perspective, today, from July last year, 2023, to this year, 2024, average Irish inflation has risen by 5.4%. What that means is that everything you can buy, broadly speaking, was 5.4% cheaper a year ago than it is today. This means, of course, that if your salary, for example, is exactly the same today as it was a year ago, you can buy 5.4% less goods and services than you could in July 2023. So how is inflation calculated here in Ireland? Well, the first thing to tell you is it's calculated by the CSO, the Central Statistics Office. And what they do is they look at a basket of over 600 different items and compare the price of those items 12 months ago to the price they are today, coming up with the figure I mentioned from July last year to July this year, 2024, of 5.4%. So while over the last 12 months, 5.4% inflation means that you can buy 5.4% less stuff, let's look at it in the longer term, in terms of wealth accumulation. And I won't use 5.4% because that's rather high. Let's use 3%. If we have 3% a year inflation in Ireland over the next 5 years, that means an erosion in value of 14% of any wealth you have. If we have it over 7 years, that's an erosion in value of 19%. If we have it over 10 years, that's an erosion in value of 36%. And believe it or not, if it happens over 20 years, it's an erosion of value of 45%. That's nearly half the wealth you think you have being eroded by our enemy, in this case, inflation. So one of the things you have to be sure of when making any investment, whatever it is, and we'll look at some of these in detail in a minute, is that the real return you're getting is the return after inflation. If you had your money in a bank for the last 12 months and it paid you 1%, by the numbers I've just quoted, that's a 4.4% loss. It's not a gain of 1%. No matter that the figure in your bank book is slightly higher at the end of the year than it was at the start, the buying power has reduced, and therefore the value of your wealth has reduced with it. So from a wealth accumulation point of view, the principal point I want to make to you is that inflation has to be taken into account, because if it's not, you're ignoring the elephant in the room. So let's talk about some of the broad asset classes that are available as investments. Roughly speaking, there are 4 asset classes available. There's the stock market, or equities. There's the bond market, sometimes called government or corporate gilts. There's the cash market, which is deposit instruments. And there's the property market, which of course is either residential or commercial property. And the first point to make is that all of these markets are impacted by exactly the same inflation. So if you invest in the basket of stocks and you get a 6% a year return, or you invest in a basket of bonds and you get a 3% a year return, both of those you need to take away the inflation rate over the period of investment to calculate the real return. So if we continue with my 3% a year as an example, in that example, the stock market has made you 3% and the bond market has maintained your value. It hasn't made you a single penny because the return has been 3% and the inflation rate has been 3%. Cash deposits are the way of holding assets that are most impacted by inflation, because throughout the last decade and more, the returns on cash deposits in Ireland have been less than the inflation rate. So cash deposits, when that is true, are actually losing you money. Property, slightly different. Property, of course, is impacted by the same inflation rate. But also, property tends to be in that basket of assets that the CSO are using to calculate the inflation rate. So the very fact that inflation is high probably means there is property inflation going on too. We did a figure on this recently where we said that it was reported that Irish residential property, for example, has increased in value by 62% on average in the last 10 years. Over that period, inflation hasn't been 62%. That means that people invested in property from a capital point of view are making money. What other investments might we include in this discussion? Well, the one we get asked about most here at Ask About Wealth is gold. People believe gold to be a hedge against inflation. And in high inflationary periods, history tells us that that belief is correct. The problem is, in low inflationary periods, gold tends to underperform. Gold, like any other commodity, its value is impacted by supply and demand. When we have a high inflationary period and lots of people changing their investments from stocks or bonds to gold, that's a high demand period and the price rises. When those same investors are selling their gold to go back into the markets when the lower inflationary period is in place, we've got more supply than demand and the price falls away. So what's the message here? Taking inflation into account when you're judging whether your investments are positive or negative is just as important as taking tax into account. If you're earning 10% a year, to make the maths nice and easy, and you're paying 40% tax on that, you're keeping 6% a year. If inflation over the same investment period is 3% a year, the real return on that asset is 3% a year, not 10%. That's the pre-tax, pre-inflation return. What you must be interested in, if accumulating and protecting wealth is your goal, is the net of tax and net of inflation rate of return. That's the only one that matters. Inflation not only impacts on our assets, it impacts on our income too. So if you're earning 100,000 a year today and inflation is 5.4% in the next 12 months and you do not get a pay rise, the value of that income is 5.4% less at the end of 12 months. So getting salary increases that are at or below inflation, at inflation simply means you're not getting any richer. So to put those numbers into context around income as opposed to capital and assets, if you're earning 150,000 a year today and you're paying 40% income tax and inflation is 3%, if you do not get an increase over the next decade, that 150,000 drops to real buying power of 67,000 over the next decade. So inflation is impacting on your wealth in terms of undermining your asset value. It's impacting on your salary in that it's pulling it backwards effectively from a buying power's point of view. And that is why taking inflation into account when you're negotiating salary increases, when you're looking at the returns of your investments, is of vital importance. So, from an investment point of view, what assets outperform inflation and what assets do not? Well, there's plenty of evidence out there, and if you simply put that into Google today, asked it what assets outperform inflation and what do not, it will quickly tell you that the stock markets outperform inflation and the cash markets do not. So if accumulating wealth is your goal, you need to avoid the asset classes that underperform inflation, and you need to expose yourself to the assets that historically outperform inflation. How inflation impacts on your financial decision making is not only dependent upon how much assets you have, how much income you have, but it also is dependent on what stage of life you're at. Inflation in terms of if your assets are now paying your income, you will have a very different attitude to inflation, and you should have a very different attitude to inflation than if your assets are in the accumulation of wealth stage. So I'm not giving advice here. I'm not saying everybody out there should be in the stock markets because they outperform inflation. I am saying they do outperform inflation. But as most of you will already know, they do that in quite a volatile way. And if you're dependent on your assets for income, volatility can be a worse enemy than inflation. What I am saying to you is that inflation effectively is an anchor to your financial progress. It is dragging along the bottom, holding you back. And you need to take that inflation into account when making your investment and salary decisions. So to summarize, inflation is your enemy. Inflation is the enemy of wealth accumulation and wealth maintenance. And I encourage you all to take inflation into account when making your financial plans. All that remains for me to do now is thank you for listening, ask you for help. If there are topics you wish us to discuss in future podcasts, please message us and give us an idea of what you would like to hear. You can do that through our social media platform.